So first things first, thanks everybody for coming out. I apologize for the line. I'll take responsibility for that one. And by a show of hands, who here is familiar with Quantopian as a company? Who has used Quantopian, that kind of, just played around with it somewhat? So for those of you unfamiliar, I'll give you a very quick explanation of what we do, which will provide a little bit of context for what we're going to talk about tonight. Then the bulk of the talk will be an actual, substantive, I think, lecture about fundamental factor modeling. So Quantopian is a company, it's a startup in Boston, and it was founded to try to make algorithmic trading more available to everybody, more accessible. The reasoning being that as of right now, if you had some idea for how to use math and statistics to trade stocks, there's pretty much nothing you could do with that idea. Quantopian was kind of started to fill that gap. The previous best path to becoming an algorithmic trader was going to the right school and networking with the right people, and then getting through an incredibly competitive hiring process to get hired at like one of a few firms that do this on Wall Street. It's just a very difficult system. And there's probably a huge amount of inefficiency in there. And so that's what Quantopian is trying to democratize, is that whole process and make it way more meritocratic. So on Quantopian, we give you all the tools and data that traditionally would be available only inside hedge funds. And then we allow you to do all of your own research and data science that you need to figure out if you have some good idea for trading. And we also allow you to test your ideas and actually live trade your ideas with your own money or fake money if you just want to generate a track record. And in addition to that, we are the world's first crowdsourced hedge fund. And I always have to differentiate, because when I say crowdsourced, it seems to trigger a shortcut in people's brain where they think crowdfunded. So we're the first crowdsourced, and what that means is if you use our platform, you keep 100% of your IP, and we don't look at your algorithm, which is a pretty huge sea change from every other finance company. It might come as obvious that that's what you do to people here in Silicon Valley area, but if anybody has ever worked within the infrastructure of Wall Street, the default is that the moment you step into any kind of contract with that company, they own all of your IP, they own you. You can't work for any other competitors for the next 2 years. There's just a ton of restrictions. And so we don't do that. What we do is we look at the returns of algorithms that are generated on our platform. And if the return stream is attractive, and I say attractive, I don't mean high. There's a lot of statistical process that determines what is an attractive return stream. And that was I could talk for hours about that independently of what I'm going to talk about tonight. But if the return stream is attractive, we give that user a tap on the shoulder and we say, hey, would you be interested in being part of our crowdsourced hedge fund? If the user agrees, they can refuse, but if they agree, then their algorithm gets a chance of being allocated capital. And what that means is that if they get allocated capital, they take home 10% of whatever returns they're making on the capital. And it's a profit-sharing agreement with Quantopian. So an investor would give us capital, we'd allocate it out to the user algorithms, we'd take home maybe 10% of the profits, you'd take home 10% of the profits, and the investor would take home the rest. That's the agreement that we have with the users. So we're just getting started now in terms of setting ourselves up as an actual fund that can do this. And so we're at a point where we're really looking for strategies that users generate on the community. So I'll give you a really, really quick overview of some of the cool features that Quantopian has, just to get you kind of an idea of what we're talking about. So when I say back testing, how many people know what that means by a show of hands? Okay. So I'm going to define that. So when you have some strategy to trade stocks, that strategy, whatever it is, it's a black box, right? And you want to figure out how that strategy would have done over some historical time period. That's back testing. And this is a concept that kind of came out of finance, but it's not restricted to finance. Anytime you have time series data and you have some kind of forecasting method, oftentimes you'll run test forecasts on historical data and test how your forecasting method would have done, and that's basically backtesting. We give you the ability to do that, and I'll just show you a quick example of what that might look like if you're running on the platform. So this is my algorithms garbage bin right now. It's full of a lot of stuff that I need to clean up. But this is an algorithm. It's Python. The platform is Python based, and I'm not expecting everybody to understand this. It's not a ton of code, but it's also not a small amount of code. The important point is that this does stuff. It looks at the market data as it comes in, and it makes decisions about whether to buy or sell. So if we were to run a backtest on this algorithm with between a certain date range and with a certain amount of starting capital, we can immediately start seeing how this algorithm would have performed over that date range. And so you can do this for any strategy, any kind of idea that you might have. You can run this way. Yeah. Yes. So that's a huge problem in finance that I don't have time to go over tonight. But the idea that the companies that are alive today are the companies that didn't go out of business yesterday, and that's a huge problem in a lot of financial data. We basically handle that in a few different ways, but the short answer is we do handle it and are aware of it. But you do also have to put some effort into making sure your algorithm also doesn't trick itself into not handling survivorship bias. So, stock splits, yep. So that's also a really tricky problem, and I think it's something that the engineering team actually has recently been working on making sure that we handle right in every case. Of course, the issue is that when you have the question, what was the price of Apple at January 1st, 2015, the date on which you ask that question actually matters. Because if you say, what was the price of Apple on January 1st, 2015 from the perspective of December 31st, 2014, you're going to get one answer. And if you say the next day, you're going to get a different answer. For instance, on December 31st, the answer is, I don't know yet. On January 1st, 2015, the answer, there might be a misprint. Maybe your data provider gave you a wrong number and then later corrected it. So if you go on Yahoo Finance, you actually get corrected data there. Anytime they come out with a misprint, they go back and they retroactively correct it. And that's bad because if you're testing your algorithm on Yahoo Finance data, it's going to mask all these days in which these bad data points would have come in and screwed up your strategies. So that's just an example of kind of a bad data problem that a lot of places can have. So this is the backtester. And then we also offer a hosted IPython research environment. Are people here familiar with IPython notebooks? Okay, so I'm going to go ahead and talk about the lectures really quick, which is what we're going to do tonight. But the lectures are something that is kind of popped up in the last year of the company. We built all these tools for practitioners, but what we realized is that there's a big need in education because a lot of professors are teaching this stuff, but they have no way for their students to do any kind of applied homeworks on it. Sometimes professors will build their own haphazard systems. Sometimes they'll pay for data sources. Sometimes they'll have trading rooms available in their school, but oftentimes it's a pretty big pain and hassle to actually give your students assignments based on any kind of finance or trading homework. So we realized, wait a minute, we can do that now with Quantopian. So we started working with a lot of schools, including Stanford locally. And out of the process of working with all these schools, we came up with a lecture curriculum that was part of it's stuff that the professors had taught, part of it's stuff that we think is important. All of it is really verified by professors. I'm constantly trying to get this in front of professors and have them look at it. And I've gotten a lot of corrections and feedback on oh, you're teaching this wrong, or you need to spend more time on this, and constantly updating the curriculum to take that into account. So I can pretty confidently say at this point that this curriculum is just as good, if not better, because it's hands-on than anything you'd get going through a Master's of Finance program at a top-tier university. Because that's the professors that we're talking to. They're teaching it at top-tier universities, and they like it, so it's kind of the same stuff, but with more options than you're normally used to. So, and in addition, I just want to give a quick shout out. We have also started doing on-site workshops in which we go over for a full day and people show up with laptops. I work with them to get everything up and running, go through some of these lectures, have exercises that everybody does on their own machines. It's really a great way to learn this stuff, especially if you've been putting it off for a while and you want to kind of force yourself to actually go and learn some of this stuff. We have one more workshop set up on Saturday in San Francisco. So if anybody is interested, the registration link is on our website. If you go to quantopian.com/workshops, you can take a look and check it out. We have about 6 spots remaining right now, I think, out of a 15-person workshop. So if you're interested, I recommend getting it sooner than later because we've also got some interest from some other groups in the area and have to decide whether or not to open it up to them tomorrow. So, okay. We're going to talk about the lecture series. So what we're talking about today are fundamental factor models. Who here has dealt or heard of or knows somebody who has heard of fundamental factor models? Okay. Factor modeling as a concept in finance, people know what that means. If I said a linear factor model, you guys be able to like have a dinner table conversation with me about that? So they're really, really big now. Basically, finance has gone through a couple big revolutions, and the most recent one is factor modeling. And what factor modeling is defined in this lecture, which is arbitrage pricing theory. So that's the first one we're going to talk about. So this is our research environment. And for those of you unfamiliar with IPython notebooks, we offer hosted IPython notebooks that have access to market data. And everything here is in browser. There's no installation step or anything. They are combinations of text and code and plots and all sorts of fun stuff. And you'll see as I go through it, you'll get an idea of how they work. But the general idea is that you can just have analyses in the text portions, and then you can like send these notebooks to your colleagues, and kind of it's all one nice unified thing. They're really, really good for teaching, and a lot of schools are switching over to teaching their data science classes with some environment like this, and IPython notebooks have taken a pretty big market share. A lot of really good data science classes are using these just because it's so natural to have a living textbook like this, where rather than just a static textbook where you go over the theory, you actually have the text of a textbook, but then rather than just listing the formulas, you actually have the formulas and then code to implement the formulas, and you can kind of play around with it, break it, see how it works, all that stuff. So that's the goal with this. So arbitrage pricing theory is one of those things that sounds kind of boring, and it is kind of boring, but it's important. So the general idea with arbitrage pricing theory, and we're not going to spend too much time on this notebook, comes from factor modeling. So this is a factor model. What this means is that we are expressing the returns on some asset at time I. Okay, that's important. The returns on some asset. Everybody here familiar with what I mean when I say the return on some asset? Anything you can buy and hold is an asset. And the value it gains or loses, that's the return. And pretty much you can think of anything as an asset. Think of your house as an asset, because at some point in the future when you sell it, it will have gained or lost value. And the value of something is only determined by the amount of money you can sell it for. That's like economics, like something has no value if you can't sell it. And so, you know, a chair is an asset. Most things you would buy in your everyday life are depreciating assets because they lose value as you own them longer. But in finance usually deals with appreciating assets, things that are going to gain value over time. So the return on some asset at time I is equal to a constant intercept, and this is just a linear regression model, a constant intercept plus coefficients times these factor variables, plus some error, because you always have to throw error in. And all this is it's saying, make me a data set where the outcome I'm trying to model is the return on some asset at time I, and the variables, the columns I have, are the values of these factors at time I. And what you're doing is you're trying to figure out like if there's relationships between certain factors and returns on some assets. Here's a natural one. This is a generalization of what's known as capital assets pricing model, which is an innovation that happened to the finance, which was just saying represent each asset as a linear combination of market movement. So in this case, it's just one factor, the market. So when I say the market, I mean the S&P 500, and that's kind of generally used to mean the market in a lot of cases. So when you hear about like the S&P 500 gained 1% today, that's the return on the market, 1% up that day. And so what you can do is every day you have a return on the market, and every day you have a return on some asset, and you do a linear regression, and what you'll get is a coefficient times the market and this alpha, this constant intercept. And this coefficient times the market is known as beta. So you'd write beta in a linear regression mathematical model. And so when you say something's beta to the market is estimated by this model, you mean that, let's say that you estimated the beta to be 2 over some time period. What that means is over that time period, when the market's gone up, your asset has gone up twice as much. And when the market's gone down, your asset has gone down twice as much, on average, on expectation. People understand why that would be the case? If you've estimated a linear model like this, and you've estimated this coefficient to be 2, really what it means is that the effect on this return stream of this return stream is it's doubled, magnified by 2, on average over that sample. And then the other thing you have is the alpha, that constant intercepts, as they say. And the alpha is what's left over when you've taken market movement out. And that's a really key concept, because what you're doing is you're decomposing, right? So people here familiar with signal processing, you kind of get at the idea of you have some signal, and you want to decompose it into different parts. So anybody who's dealt with fast Fourier transforms before knows that it's very natural to, if you have some signal, decompose it into different parts that can be easily managed and modeled, and then easily kind of treat that final signal as a combination of those parts. This is what this is doing. So it says that if you say, let's say that some assets return estimated as alpha plus 1 times the market, that means that it's pretty much moving equally to the market. So it's kind of tied to the market. And most assets on the stock market, most like equities, when I say equities, I mean just like a stock like Apple or Microsoft or Yahoo. Most of those are close to 1 because they move with the market. When the market goes up, they go up about the same. When the market goes down, they go down about the same. And one way to convince yourself of this is that if, on average, all of the assets combined didn't have a beta of 1, that wouldn't make any sense because all assets combined should be the market. So on expectation, most assets are going to have something. There's going to be a distribution around 1. And it turns out that distribution is kind of tight. There's a lot of things that have very 1 betas on the stock market. So, sorry? Yes. So, and what finance is always trying to do is figure out, okay, well, given that like any one asset is not necessarily going to behave that interestingly, how can we pick interesting sets of assets to get non-market behavior? That's what a lot of finances do. So that's the idea of a factor model. Starting with a very simple like 1-factor model, a single factor of being the market, and then expanding that out. So let's say from that example, you said, okay, now I'm going to add another factor. I'm going to add the price of oil or the returns on some oil. If I'm holding oil, what returns am I getting on that every time period? And so that's another factor, right? And oil company stock should probably be pretty influenced by the price of oil. But other companies may or may not be influenced by the price of oil. And then you get into all sorts of weird confounding variable situations where, like, does oil move the market or does the market move oil? And where does the causality go? And that's, that's another subject that I could talk about for a long time. We're not going to. Just be aware that it's a problem. The important point here is that linear factor models are kind of the bee's knees in finance right now. And all the time, professors who are really good at them are being kicked out of academia and hired for ludicrous sums of money to go work for large financial institutions. Because it's kind of very, very popular now for financial institutions to start moving a lot of their assets into factor model-driven portfolios. Yeah? That's another big problem in finance, is that getting at any of the data you need to make these models is really tough. And it's a big, again, a huge sea change from what a lot of you might be used to being in kind of the Silicon Valley area. In the Silicon Valley area, there's kind of a glut of data right now. Like, so many companies like now are just putting their data up on Kaggle, and they're being like, please tell us what's going on here. Whereas on finance, you're like, in finance, you go up to somebody and you're like, you know, can I get your data? And they're like, okay, well, pull your checkbook. Let's talk. Are we talking like $20,000, $100,000? Which data set do you want? How many people are using it? Like, I'm not joking. The normal price for one data set for a year to rent it from a company, just for simple stuff like market data, is like $10,000 to $20,000 per person. So that's another problem that Quantopian is trying to solve. So in addition, we offer you a lot of free access to pricing data and Morningstar fundamentals. I'm not going to go into what those are right now. We'll talk about them a little later. But we offer you a lot of access to free data. And then in addition, we also have this new addition called the data store. And the data store is where data providers offer their data on a monthly subscription basis to Quantopian. We actually, through a clever twist of business models, can get the price way down from what you would normally expect from data providers. And the reason for that being we can take out a lot of overhead in the sales pipeline. So they just don't have to charge as much to make it worthwhile to them. So we're trying to solve that problem, long short. So are people here like comfortable with what I mean by factor model now? Like, they get at what this is doing? It's modeling one thing as a combination of these other things. And these other things, usually you'll have the market in there, but then there's, you can kind of mix and match for your other thing. Kind of choose whatever factors you think might be related to the thing you're trying to model. Yeah. So, I mean, thank you. The question is, could we elaborate on the cost of data? That's an entire discussion in itself, so I'll give a very quick, a bit hand-wavy explanation. The model that has been set up in finance forever, and finance is all about tradition, it's all about old money and tradition, is that you have a guy in a suit, and he meets another guy in a suit, and they're talking about two companies selling to each other, because why would an individual need this data? It's just a hedge fund is buying from a data provider. And they wine and dine them, and they put like 3 people, salespeople on the project to make sure that they sell this data set. And the overhead that they incur selling these data sets is anywhere from like $5,000 to $50,000, depending on what data they're selling and who they're working with and how much they have to fly back and forth. So the price just to get decent margins on this data ends up being in the tens or millions, depending on what data set you're looking at and what type of purchase or sale you're making. And there's really no model that has been set up before Quantopian in which you can kind of efficiently sell to individuals without accumulating a lot of overhead. So that's the big difference here. Okay, but going forward, so once you understand like factor models, I'm going to go briefly through arbitrage pricing theory because it's not super important for what we want to talk about tonight, but I think it's interesting to note. The idea with arbitrage pricing theory is that once you have these factor models, arbitrage pricing theory basically says you can start making lots of estimations in both directions. Because if you know expected future returns, you can start making statements about the factor values and then the risk associated with each factor value. The idea being that in finance, risk premium is a huge, huge concept, and it's very different from a lot of other machine learning. So Gideon, one of the co-organizers here, always likes to make the point that in machine learning, as it's normally done, you are pretty much looking to maximize reward. You're looking to you have some reward function and you're looking to maximize reward. But in finance, it's so easy to overfit and make predictions that just aren't very good out of sample, that usually what you end up doing is you're looking to minimize risk. Because every single asset you can hold in finance has a risk associated with it. And whenever you want to get higher returns, you generally have to take on more risk to do that. And so the idea is that, let's say that you had two assets, right? And one of them had an expected return next year of 10%. The other had an expected return next year of 10%. But one of them was risky. You would, of course, choose the one that's less risky. That's just kind of an easy choice. So for those of you who are familiar with like Pareto optimality, basically you get these situations in which investors are not willing to accept more risk unless it comes with higher expected returns. You have to be paid for that risk that you're taking on. And so arbitrage pricing theory gets at that because think about it this way. Once you've estimated exposures of one return stream to other return streams, now you have risks. Because let's think about it this way. Let's just say it's a single factor model and it's the market, right? Let's take something like Tesla, which for a while was hanging out at a 2 beta, right? So it's twice as volatile as the market. Market goes up 1, it goes up 2%. Market goes down 1%, it goes down 2%. On average, on expectation, not every day. And so with Tesla, that's pretty volatile. It's also, it's prone to weird behavior, weird jumps, weird drops. And what you can do is you can say, okay, well, how much of that risk is coming from the market movement? Because if my stock is moving at 2x the market, how much risk do I associate with the market? Well, and then take that amount of risk and say, okay, well, now I associate twice that amount of risk with Tesla. And that's just the risk that's coming from the market. And then if you take that out, then you get left with, okay, what's Tesla really doing in excess of the market? And that's what finance people are always looking at. They're never looking at actual returns. They're always looking at returns adjusted for other factors, because you want to get rid of all the stuff that you know about, like market movements, oil price movements, all that stuff, and say, okay, well, when you take those away, is there anything extra interesting happening in this asset? And those are the interesting assets. Those are the ones that are behaving interestingly and you can do stuff with. That's expressed by the alpha. Because in this model, the alpha is whatever is left over when you've taken away all the other factor dependencies. So what you can do with arbitrage pricing theory is you can say, well, assuming that investors will only buy stuff if, a riskier asset if it has a correspondingly higher return, you can kind of set up these nice little equations that you can solve to try to figure out behaviors. Of course, this assumes that you have an estimate of either future returns behavior or future factor behavior. If you have an estimate of neither, then like, what are you even doing, So if you have an estimate of one, factor models give you a way to carry through behavior to other things. So for instance, if you have estimates of future risk of the market and future risk of bonds, then you can be like, okay, well, this asset has this much risk associated with it, and so therefore I think the expected returns are going to be this much. Because if the expected returns are not this much, then the market is behaving inefficiently. So under efficient markets hypothesis, you can compute expected future returns based on the risk of the factors. And this tends to work on longer time frames. On shorter time frames, it's not so much the case. And then you can also go the other direction, where if you think you have some knowledge of the expected returns, you can look for opportunities where maybe something is just too risky for the amount that you expect it to get, or something is not risky enough and there's a free arbitrage opportunity. Mathematically, when you say arbitrage opportunity, you mean when there's more returns than you should expect to get for that level of risk. You're getting a bonus, right? And so that's kind of one expression of an arbitrage opportunity. So I just want to show you, again, these lectures, anybody can access them. So if you're curious, please download them later, play around with them. I'm just going to go over and kind of show you an example of this here. what we're going to do is we're going to look at these three names, HSC, Microsoft, and the market. And then we're also going to use BIL, which is a stock, as a proxy for the risk-free rate, which is the treasury return. This isn't what you should actually do in real life. This is more of a learning example. We needed to get the data from somewhere, and so we just use this for now. In practice, you can generally assume that the risk-free rate is 0, and that's what most practitioners do, and that works out pretty well. And so what we do is we just say, we make this into a data set where our columns are two assets. Those are our return streams, and then the three things that we want to estimate, which are dependency on the S&P 500, dependency on the treasury returns, and dependency on constant, which is the alpha. And then we just run a linear regression model. And so over that time period, this gives us an estimate of Microsoft and HSC dependency on the market risk-free rate. 1.72. And then you're going to have a lot of instability with the constant on the risk-free rate because the risk-free rate is so small that the beta is going to like bounce around a ton. Because it's just, you have to have a very high multiple to make that a meaningful number. Issues with data normalization here. So, of course, one thing that I'm not going to have a lot of time to talk about tonight, but I talk about a lot in other sessions, especially, for instance, like the workshop on Saturday, is all the problems associated with this. So this is the traditional, like, naively do. If you went to Bloomberg or something, and you just said, what's the beta on this stock, right? And that's not good because that's the beta over a specific time period estimated on a specific set of data that you've gotten your hands on using this model to estimate the coefficients. And so one thing you might want to ask yourself, okay, well, how consistent is that beta exposure? So the next thing we can do here is generate all these statistics, but on a rolling basis. Now what we do is every day, you look at the last 90 days of history, and we say, do the linear regression analysis on those 90 data points and compute the exposure over the last 90 days. 90 is, you know, pick whatever number you like. 90 is a nice one. And that's what this looks like, okay? So here we can see the blue line is the beta to the market, so the multiple on the market. And the green line is the beta to the risk-free rate. And this is what I mean by it moving around a lot because, you know, the risk-free rate is so tiny compared to the return stream that you get, again, like I said, get into this issue with non-normalized data where you have this big constant trying to take that into account. And of course, whereas the beta to the market looks pretty tight in this case, you know, it looks like a pretty consistent estimator, it's all about scale. Because if we zoom into that, down here, you can see this is what it looks like zoomed in. So height is relative, and it depends on the scale of your y-axis. And basically, you need to decide what a comfortable range is for you. Do you need to have a consistent estimate that's within 0.1? Do you need to have a consistent estimate within 0.5? And then just say, like, that's the scale on the y-axis that I'm going to look at, and let's see if this still looks consistent. So in this case, I would say that this is not a good estimate of beta because it's moving around so much that, like, you can't really say anything about where it's going to be going in the future. Because the other thing you have to remember is that everything in finance is predictive analytics because you really don't care about what happened yesterday. In fact, pretty much everything in life is predictive analytics because yesterday already happened, and any decision you ever make is based on estimations of what's going to happen in the future. Like, by definition. Just information about what already happened is useless unless you can use it to construct an estimation of what will happen in the future, as far as decision-making goes. So here we're looking at historical betas, and basically what you have to understand is, like, the only reason we look at these is to construct forecast for future betas so that we can make decisions based on what future risks and dependencies will be. And if these historical betas are bouncing around a ton, then we really can't gain anything from this signal. This is just it's an inconsistent estimator, and Nate Silver would tell you not to use this. Just not, it's noise. There's not a signal. So that's just a very important thing to keep in mind. I do like a full 3-hour session on talking about like these kind of issues and overfitting bias and survivability bias and estimate instability that pops up in this type of time series predictive analytics. But the general idea is that you want to get a consistent behavior because if you have no consistency, then you just can't say anything about what's going to happen in the future. And kind of all statistics is about this. It's looking for when things have behaved consistently the same way in the past and saying, okay, we hypothesize that that will continue to happen going. You could, but you're making several assumptions when you're doing that, including that the distribution of the betas is normal. Because if the distribution of the betas is non-normal, then your confidence intervals are going to be wrong. And most things in finance are autocorrelated, which means that the distributions are not going to be normal. And so you have to be very careful about implying different types of corrections to your data and detrending it and removing autocorrelation and that kind of stuff before you look at any confidence interval. But yeah, so the general idea here is that it's all about predicting the future. And so here's an example of like, okay, well, assuming that this was a consistent estimator and we'd found a model that was decent, what we'd then do is we could say, okay, well, now we know how our returns behave based on these factor values. So make an estimate for the future returns of our asset based on market behavior. And so that's just an example of what you could do. That's the data I have coming in the regular blue line. And then the dashed blue line, this is what I expect will happen going forward. And another big concept in finance is that you don't expect that this is actually what's going to happen, right? You don't expect that you're going to be able to predict that it's going to go down and a little up and then down again and then way up. And like, what you're trying to do is you're trying to say, if I make this prediction over thousands of assets, a signal will emerge. I'll get my 51% edge. I'll get better than random. I'll be able to make more good bets than bad bets. And that's what a lot of finance is about. The example that I like to give is if you know how to count cards and you can get your 51% edge on the house in blackjack, and you have some way to not get thrown out by the casino and beaten in the back alley, you walk into the casino with $10,000 and put it down on one table, which is kind of the equivalent of expecting to be able to predict the movement of one asset in finance. No, of course not. What you do is you put down $10 on 1,000 tables. And because you have a 51% odds, the more bets you make, the more on average you will converge to those 51% of bets won. Conversely, if I said, tomorrow you're playing a tennis match with Roger Federer, and the winner gets $1 million, I'd say, great, okay, 1-point match. Let's do this. Because that's my best chance, right? I know that as the longer we play, the more he will converge to winning very quickly. So I want it to be 1 point, because that maximizes my chances that there's a fluke, right? So anytime you see somebody who's like trying to predict the prices of one asset, or like looking at charts and trying to figure out where this particular security is going to go, I kind of view that as being akin to not being confident in your ability to predict things, because you're putting so much of your money into one specific bet that really that you only want to do that if you think that you don't have a good chance to beat the market in general. And if you really do think you have a strong predictive model, you want to make as many bets as possible over as many assets as possible. That's the idea. So that's like kind of my dim introduction to factor models and why they're important and a few other curious issues. And then what I want to talk about for the next while is a few examples of this. So first thing we're going to talk about is risk factor exposure, and then fundamental factor models. So risk factor exposure is super important. And like I said, pretty much everything in finance is about risk. And you're trying to control risk, estimate risk, minimize risk, all sorts of stuff to risk. And in finance, by the way, risk is just defined as volatility. Same thing. So when you take the standard deviation of a return stream, that's the risk. That's known as volatility, just the standard deviation of that time series. And then that is how risky that thing is. It's a unitless number, but what ends up happening is that all these equations kind of treat risk as unitless to an extent, and then it can boil out in the wash that you get the numbers you want at the end of the day. Or you can use numbers that kind of explicitly try to figure out what percentage risk you're contributing, and that's what we'll talk about here. So let's say that you had an algorithm, right, that was trading stocks, or let's say that you were trading stocks, or your buddy was trading stocks, and you wanted to figure out what's going on. Like, how do I model this? How do I predict what's going to happen in the future? How do I say how risky their strategy is? Because people who trade stocks by hand, you can't say, okay, go back to 2005 and pretend that you don't know what's going to happen and then make the trades as the data comes in, right? You can do that for an algorithm, but you can't do that for a person. And so, and there's a huge amount of survivability bias in there too. Like, do people know what survivability bias is? It's a really key concept in data science. What it means is it's just the idea that if you flip 100 coins and you flip them 5 times, you're going to have just purely, you can run your probabilities, and you'll figure out that there's some number of coins after 5 flips, if they're 50-50 coins, that will have gotten 5 heads in a row, and some number that will have gotten 5 tails in a row. But it's non-zero. It's a specific number, and it's a multiple of, it's a percentage of 100, right? And so when, this is Silicon Valley. So if you're working in a startup, and the startup gets lucky and goes big, and you suddenly have millions of dollars at your disposal, you will get a call from many wealth managers, because every bank has a department of people whose job it is to track the millionaires that pop up. So as soon as you're at a startup that looks like it might go public, all of a sudden, I guarantee you will have a file on the desk of people at Morgan Stanley, Goldman Sachs. Your name will be in there, and they'll just be waiting until you have that money to literally call you on the phone and say, hey, finance is hard, let me manage your money for you, right? And what they'll always say is they'll say, look at my track record. I've got 40% return every single year for the last 5 years. But then, what you should say is like, okay, well, what about survivability bias? Because the managers that got minus 40% on the first year probably are not the ones calling me on the phone right now. So how do you know that that person who's claiming 40% per year for the last 5 years, how do you know that he's not just there because they were all making random trades and he just happened to survive the longest? Right? That's a really difficult problem, and it comes up all the time in finance and all sorts of other data science issues. And there's no easy answer to solving that problem, and it's distinguishing luck from true skill. But you can start getting at some of the ideas behind it by looking at various metrics of their performance. And so what you might want to say to the wealth advisors, okay, great, give me your daily returns for the last 5 years. None of them will give that to you, period. It's just, as finance is secretive, and they've got this rig going where none of them give it to you, and they all agree that none of them are going to give it to you, so you just have to guess, right? And if you have the daily returns for the last 5 years, you can start doing a lot of interesting analysis on it. And of course, the issue is that when you're going to pick wealth advisors, for those of you familiar with like the Dunning-Kruger effect, which basically says that the skills to tell if you're doing a good job are the same as the skills you need to do a good job, so people don't know when they're doing a bad job. That happens for choosing wealth advisors. Because if you want to choose where you're going to put your money, you have to have the same skills as the people who are managing your money to analyze their performance and decide if they're actually doing reasonable things with your money. You're in a bit of a catch-22, right? So, and a lot of this comes from just the lack of transparency in finance. Nobody's willing to say what they're actually doing. But again, if you have that return stream, you can start doing a lot of interesting stuff with it. And like I said, a return stream can be a wealth advisor is an asset, an algorithm is an asset. They all produce returns every day, right? And let's say, algorithm, have this R, and you're modeling it as a combination of these risk factors. Important, because now what you're trying to, how much of my risk is coming from each of these factors? How dependent am I on these other factors? Because if you have the wealth advisor's return stream and you find out that there's actually a 3x dependency on the S&P 500, then why would you pay his fees rather than borrowing 200% of the money you already have and buying the S&P 500 index fund, which costs nothing to own? Right? The same thing. You're just going to get 3x returns on the S&P 500, and if it goes down, you're going to get 3x losses, but that's your problem. So the general idea is that once you decompose returns, a lot of things start coming up, and you'd be surprised at the number of hedge funds who just boil down to leverage bets on the market. And by leverage bets, I mean borrowing money and then putting it all in the market. And you can't tell that because they're not going to give you their daily returns. That's too privileged. That's their private information. So it's just something to be very aware of. But again, once you're looking at your own algorithms and trying to choose, once you have more control and you can actually look at what's going on, then you can say to yourself, oh, well, I just developed this really fantastic deep neural net natural language processing machine learning algorithm that selects stocks. If at the end of the day, it boils down to a return stream that's 2x the S&P 500, that's just, that's not interesting, not worth using it. So the important thing to remember is at the end of the day, the only thing that matters is the return stream that's coming out of your algorithm. And so this is really looking at analyzing that. So what you do is you say, okay, well, I do that factor model, and I get my coefficient over some time period for each factor. And then what you can do is you can use this clever formula, which I'm not going to go into too much, but again, these lectures are freely available, and you can feel free to delve into this in your own time. The general hand-wavy explanation is that this computes how much risk each factor is adding to your overall risk, taking into account that factors are going to be correlated with each other. Because if two factors are correlated with each other, you can kind of think of them as just being one factor, right? If you have two things which are 50% correlated with each other, then what you should probably do is think of them as get rid of that correlation from this one, look at just this one's effect, and just this one's effect. You can do a PCA analysis and look at just the eigenvectors of the factors. So that's what this is kind of trying to do, is it's trying to the correlation effect. And then the other thing that this incorporates is called active risk. So remember when I said that what people in finance care about is what's happening above the market? That's what this is. It just says your returns minus market returns. So in signal processing, it's that minus that. So you just take all the market returns out of your returns. That's what you're doing above the market. That's what you're doing. That's what's interesting in what you're doing. And that's known as your active returns. So the idea being that your inactive returns would just be invest all in the market and go away. That's the Warren Buffett model. And your active returns are actually trying to buy and sell in a clever way. And so your active risk is the risk of your active returns. And remember, risk is just volatility equals standard deviation. So it's just take the standard deviation of your returns minus market return. That's your active risk. That's the risk that you are adding by doing your own trades, as opposed to the risk that the market is adding just by being there. So that's what this formula does. And we'll just run an example of this. So again, we'll say the thing we're going to do here that's a little different is we're going to have factors that are based on portfolios constructed from fundamental values. What do I mean by that? Well, fundamental factor values are things that you get from the balance sheet of companies. So how much cash they have on hand, how much debt they have out, what their margins are, all that kind of stuff that, is kind of boring, but really what's going on inside a company. And one of the data sets you can access on Quantopian is all of that information for every company on the US market going back, I don't actually know exactly how long we have it, but it's a point-in-time database. You can look at every time step, like what those pieces of information were. And so what a lot of fundamental factor modeling is it's saying, well, let's look at our risk dependencies on those factors. Now, what does that mean? Because you don't have any one value of market cap, let's say, for instance, right? Every company has its own market cap. There's no one market cap value that's for everywhere, right? And if every company has its own market cap, how do you transform that into a factor value? Well, what you do is you sort all companies by market cap, and then you buy the companies. If you wanted something that's large market cap, if you wanted that to be your factor value, what you do is you'd buy the top 1,000 companies by market cap, and you'd short the bottom 1,000 companies by market cap. By the way, is everybody familiar with the concept of shorting a stock? By show of hands, who isn't familiar? Okay, so just for anybody if you're not familiar, shorting is a bit of Wall Street black magic. It allows you to bet on something going down rather than something going up. You can just think of it as the mathematical equivalent of a negative position in something. And what it means is sell something if you don't own it yet, which again, like, you can go and figure out exactly how that's done. It involves borrowing money from your broker, but just think of it as a -1 in terms of how much you own of that thing. So what you do is you short the companies at the bottom of your ranking, and then you say, what would the returns be on that portfolio? And what that does is it gets rid of the market motion because you're equally long short in the market. So if the market goes up, the money you make on the top ones will equal the money you lose on the bottom ones, and vice versa. So this is known as market neutrality, when no matter what the market does, that portfolio stays the same, and it goes up and down based on other things. In this case, it goes up and down based on the spread of returns between big and small companies. It's a well-known fact that small cap stocks tend to outperform large cap stocks long term. That's just kind of a known thing in finance. And so, unfortunately, you can only really get at this by having these long-short portfolios, because small cap stocks can also be more volatile because they're smaller companies and weird things can happen to them. But if there were, for instance, a mutual fund that allows you to say buy or short, short the biggest companies and buy the smallest companies, those strategies tend to do the best long term for investing. And it's a well-known factor. People have won Nobel Prizes for determining. So we're constructing that factor in which once a month we sort all the companies by their market cap, and we construct a portfolio based on that, and then we say how much returns would you have gotten from this portfolio. And then we do the same thing for book value yield. The important thing to realize is that you can do this for any factor you want. Market cap is just a very common one. So in this example, again, I'm not going to go into the code too much, but what you can see here is what I said, we're cap, and then we're top. I get the return bottom, factor return top minus bottom is our daily 1 month of holding that portfolio. Just do that for each of the months in our data set and stitch that data together, and then we have this long-term return stream. And so now once we have this return stream, we can plot it. You can see here, this is the time. Again, long-term, it's when it's going to outperform. Short-term, you can see here, so daily return, this is the Q. For holding it long-term, how you would have. And again, this is only over a specific time period. And so what you do once you have those returns every day is you can do your linear regression factor model, and get your betas. And so in this case, we look at HSC, again, as our asset. I have no idea what company that actually is. That's what we're using. The important thing to remember is, again, it doesn't matter what company that is. The only thing you care about is the return stream. And you want to kind of divorce yourself from looking at each company as having personality. So what you do here is you run your linear regression model, you get your coefficients, and that's great, but obviously we also want to look at how they do when you're rolling your coefficients, because like I've said, looking at one time period by itself, just an average, is not necessarily very good. So here's the rolling 30-day, in this case, coefficients. And you can see tendency. There are two fundamental based factors. No. Inconsistent. So could you necessarily say anything about future dependency on these factors going forward? Probably not. And again, what you're trying to say is how much risk in the future will owning HSC have based on factors, right? Because in general, in algorithmic trading, what you want is algorithms that have very little dependency on risk factors. Make sense? You want things that are just, they'll go up no matter what. They don't have high multiples of other things. That's the idea. And the idea is that if they have a high multiple of something else, the investor can just buy that other thing. Why do they want to buy your algorithm? It's like you have this nice algorithm, and then like hanging on to the algorithm is the market or something like that. And it's just, you don't want that. So you generally want to try to minimize your exposures. And so if you have like these wildly fluctuating exposures, that's not good because confidently predict that in the future you will still have low exposure. And then the last thing we do in this notebook is actually just we compute the percent contribution to risk using this formula and that rolling data that we've just generated, and it just normalizes it to a percent contribution. Again, this particular example, not very useful, but the techniques that are used are what's used in finance. And these are like the same techniques that you'd want to use with other factors and other assets to look at what's actually going on. Yeah? Yeah, that's true of everything. Well, so you'd be incredibly overfit in that case, because you just happen to likely find a few factors that lined up really well with your return streams, but didn't really have any real relationship. And so you wouldn't be able to make predictions about future risk because you'd be so overfit to your... In general, it's really tough to get rid of overfitting if you have tons of factors in your... I would be very surprised if you could make any reasonable predictions on like factor models that have more than, like, say, like 5 factors. And the reason for that, again, like I said, some of them will just happen to line up in your testing data set, and then out of sample, a lot of those relationships will break down, and your predictions just won't necessarily. But again, this is like, I could talk about that for a long time, and the last thing I want to talk about tonight is just the final notebook for a few minutes, which really just is itself a combination of what we've talked about before, so I'm not going to spend much time on it. But the important thing that I want to note here, in response to the earlier question about confidence intervals, well, you might say, okay, well, you know, these aren't consistent, but falls within distance. I predicted this range of risk exposure. But okay, great. I just run a normality test on counter exposure numbers. Value of say 1% cut off. These are not normal. Confidence intervals. Have to do another step of predictive modeling, which involves like detrend theories and all sorts of stuff like that. So it's just something to be aware of. So the last thing I wanted to talk about, and I appreciate everybody bearing with me. I know we started late because of the line earlier, It's just the final notebook. And I just wanted to run you guys through it so you run through it more on your own if you want to, but it really gets at the same concepts as before. All we're doing is we're constructing those same two factors, market cap and book value yield. So we're making those portfolios where we go long and short and then looking at the returns over time. And then you can see here, in this case, we have three factors, one of them being the market. We can look at the rolling exposures over time, that factor, some asset. In this case, the asset is pretty simple. It's a stock, but you would probably want to do it for your algorithm. And then we talk about like another approach you can do, which you can also normalize value of factors. So you can kind of say, what if I have some factor that's really tiny in comparison to these other factor values, and that's going to screw up my coefficients. It's going to make them very unstable. So to get everything in the same space, I'm going to normalize my factor values to kind of this z-score S thing. So that's what you can do. And I just wanted to point out that really all this notebook does, in addition to the last notebook, is just talk about that as an approach you can take. We had to kind of do a lot of the same curriculum because people might just look at the fundamental factor values notebook or might just look at the factor risk exposure notebook. So we kind of do the same analysis in both. OK, so that's factor values. That's factor modeling. I'm going to put a cutoff. I'll take questions for a little bit. There's a hard stop on people having to be out of the building at 8:45, so I'm not going to have a ton of time for questions. But hopefully that made sense in general to people and was somewhat helpful. Again, all of this stuff is available online. You can get it on your own time, and we're trying to make this curriculum better all the time. So any feedback that any of you have, like I don't get this part of it or anything, you can always just let me know, and we'll see if we can fix it. But thanks everybody for coming out, and I'll take some questions now. Yeah, you first.
Long, I assume you need to
getting some good feedback
have
here.
Something run live or server.
So the question is, I'm getting a lot of feedback. The question is, what's the process of like going from having a good idea to actually managing money? And the answer is that it's not always the same. A lot of it is developing that track record. And what you really want to do is develop a track record out of sample for as long as possible. So that means actually having your algorithm running in the market. Fake money is good. Real money is better. And so what a lot of places will do is they'll ramp up the amount of cash that they're using. That said, algorithms have minimum and maximum capacities. So some algorithms just won't make money unless they're running it over $1 million. Some algorithms will stop making money once they start running it over $500,000. Every algorithm has a range in which it can operate for various reasons that I don't have time to go into today. So depending on your strategy, oftentimes you will have to just trade paper money until you can convince someone to give you an investment that's large enough to get above that hump. But something that I would recommend you look into is we have a library called Pifolio, and that does this returns analysis. It's all open sourced, and that generates basically the results that you would want to show to potential investors because it's the tool that we use internally to grade algorithms for inclusion in our hedge fund. So it's the same metrics that you would kind of look at and want investors to see. We only look at things that have been had a 6 months out of sample time period. That's our minimum. But again, every investor is different in how much they're going to want. There's a question here first. Yeah. You don't. Yeah, you can import your own data and trade on that signal. But my recommendation is just do a lot of statistical validation on anything you want to trade on. Like if you're running a data set and you notice that there's like suspicious front running of those trades coming in for the data they're providing you. For instance, I'm pretty sure this is illegal, But there's like various fuzzy definition versions of it that wouldn't be illegal. But the general idea is, yeah, if somebody's selling you a data set, they could also just be knowing that you're going to make those trades, doing the opposite trades in advance and beating you out of the market that way. So you always want to just, anything that comes in is just a signal, and you want to do the same validation process on it to see if you could use it as a data source. Like, you should never trust anything by itself. So yeah, is there more questions or yes? So the question is, how many assets do we currently manage? And the answer is, we're actually right now setting up the legal infrastructure to be a hedge fund. So the answer is 0. And we're about to go out to investors and start pitching. This is kind of the phase that we're at. So we're looking for algorithms now to be in that first batch of algorithms that we include in the fund. Is there more? Yeah. Mm-hmm. Surprised you get more than 53 on the market. That's generally like everybody I know who's a trader, who actually like knows what they're doing, kind of operates in the 51 to 53% range. And you can beat that, but generally if you beat that, you're making far less money on each trade, which is what HFT people do. So we don't do HFT. You can go down to minute frequency on Quantopian. But HFT people can get that up higher sometimes, but there's like other issues then where they end up not necessarily making more money, even though they're right more of the time. But in practice, just for like equities and stock trading, I would be very surprised if you can get more than like in the 50s. Yeah. I would say like some college level math would be initially required. We start out with pretty simple concepts like linear regression and correlation, and we try to build it up. So like in beta hedging, we kind of hint at factor modeling, and then we really introduce it later. I would say if you've taken kind of any math at a college level and understand Python, that's probably what you need. Because if you know Python, this can be a good dictionary from Python to the concepts. And if you know the math concepts already, you can go backwards the other direction and learn Python this way. So yeah. There's a question here, yeah. Yeah, so when we look at algorithms, and we have to choose, which algorithms are going to probably do well to invest in the future, we have like a bajillion things that we look at and a bajillion biases that we try to take into account. The general approach, though, is that if something is not consistent off the bat, like if there's not a consistently tight beta, we just don't even bother trying to predict it. Because to us, it's a bit of a waste of time. And what's better is to look for more other things that are more consistent right off the bat. And again, this is kind of the Nate Silver approach of, if you have a signal that's very poorly behaved, you're kind of better off, rather than trying to do some really complicated things to get it to behave well, which will probably incur a lot of overfitting bias, you're better off just going on to something else and trying to find something else where a simple model will work. And at the end of the day, if you can't find anything where a simple model will work, then you're like, okay, now I have to go back and do some complicated modeling. But we generally tend to only look at stuff that has nice, consistent metrics right off the bat. Yeah. So you can do paper trading through Quantopian for free. And you can also do it through your broker if you have a brokerage account associated with Quantopian. And the fees that you pay with your broker depends on your account and your standing. We don't have any hard limitations right now, but we also don't have a ton of CPU power devoted to it. That's one of the issues that we're trying to get past right now. The short answer is that if you're do what you want and then see if you run into CPU limitations and then like tell us, and then we can prioritize like how we develop stuff in the future. I saw 2 over here, yeah? So the pipeline is basically the API that we use to allow you to do factor modeling-based trading. So I have time for 2 more, and then I need to make sure that we can clear out the building. Yeah, I think two people over here had their hands up. So right now we're equities only, and we're expanding into futures soon. Options is ways down the road at this point. It just due to the complexity. Yeah. Yep, absolutely. So there's alpha decay on every successful algorithm, and they have lifespans. So you want algorithms that are going to have long alpha lifespans, because the longer it takes to establish the credibility of an algorithm, the more you've eaten into its alpha lifespan, and the less you're going to get out of it in the long run. So that's another topic that's studied a lot by people in the field. And it's like every question that was asked today, there's at least one person who spent their entire career just trying to answer that question. So there's a complicated issues. All right, thanks, guys.